The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, there's multiple factors at play in this market trade right now. Even if price action is a little dull, a little quiet, we are watching weather, trade issues, planting progress and early growing conditions, South America to harvest. I mean, I could keep going. Oh, there's a WASD report coming up on Thursday too. There's a lot going on, but still not a lot that seems to be giving us much in the way of bullish momentum in these markets. We're just kind of drifting right now. Let's try to break some of this down and get some perspective. Joining us now, Mike Zuzolo, Global Commodity Analytics. Mike, good to talk with you again this week, and hopefully I didn't set us up for a ominous show today there with the open, but it just feels very quiet, and the amount of items that are out there impacting the trade, none of it seems bullish right now, Mike.
Yeah, I mean, it seems like every piece of bullish news is then countered by a piece of bearish news. And as I think we go along both last week and this week, Jesse, when we see the contradiction in the trading and the price action, I mean, look at all three of the major commodities. Wheat making a new monthly high last week, making a new monthly low this week. Soybeans making a new monthly high earlier this week. Wednesday making a new weekly low. And then corn kind of caught in the middle of both of them, and it too breaking hard in the front end against the December last week. Now the December breaking hard against the old crop this week. It just seems like that kind of price action is what you're talking about. So no, I don't think you put any kind of pall over our conversation today. I think what it really means is that this conflicting information that's coming through and the trade truce that we continue to have with U.S. and China after the London meeting all kind of boiled down to me is does the WASD report you mentioned for Thursday kind of break the log jam and open up the price ranges and give us a trend for the rest of the month of June when it comes to wheat, corn, and soybeans?
Let's talk about that a little bit. I mean, as we gear up for that WASD, the June report's typically quiet. A lot of folks put more emphasis on the end of the month acreage number from USDA. Is there anything that you're seeing that could potentially give us something here with the June WASD, Mike?
Yeah, two big things. I think the number one thing would be the world wheat ending stocks number, because we've really got an issue with not knowing how bad China's drought is. That's what we traded last week. The China Daily has told me this past week that we're probably a little over 70% harvested in their winter wheat crop over in China right now. The second thing that we're trading this week is Russia's weather. And this is a real dynamic here that forces me into a defensive posture, Jesse, because one thing that stayed consistent, and that is the corn cannot seem to do anything by itself without the wheat giving it the okay, especially to the upside. But if wheat goes down, the corn tends to fail. And so it's still a wheat-led market. So what we have this week heading into the WASD report, uncertainty in China, and we have the Russian ag minister coming in and saying, hey, look, our grain crop is going to jump. We're going to go from 130 million metric tons last year to a 135 this year. And a lot of that's going to be thanks to the winter crop, which is essentially wheat. This map that you're looking at, though, when it comes to wheat production in Russia, knowing that the southern and North Caucasus regions produce 40% of the wheat, that Rostov Oblast and that area that we're looking at in the far left corner of that map that produces so much of the wheat, it's in a serious drought situation right now. And I would say to you that Rostov Oblast, in fact, that their own people in Russia, the head of that oblast came out and declared an agriculture drought emergency the exact same day that the ag ministry bumped up this production forecast for the grain production. So I think that does put a lot of extra impetus on the USDA numbers. The average trade guess right now for 25-26 ending stocks is right around 265 million metric tons, and that's a Reuters poll, I believe.
Mhm.
I'm at 256. I am 9 million less than the average trade guess because of Russia and because of China, and a little bit because of some of the extra water that we saw in Australia about a month ago.
Well, and thinking about Russia as well, this is another chart here looking at soil moisture and comparing the past 5 years, just to kind of put into a little more emphasis that maybe there is a weather story in Russia right now, Mike.
I think there has to be when I look at this kind of a diagram, when you look at the previous 5 years, and this is the exact same area that we were just looking at on the map, and you've got the lowest precip or root zone soil moisture profiles than you've had in 6 years, including this year. And so I think something's going to have to give. I mean, I won't argue that maybe they can do a 130 total grain crop because they added acres, but to jump it this late in the year, given the weather pattern that they've had, not just in this southern district, but also in far western areas, and the freezes that some of the areas like Volga had, I just am really skeptical that the Russians have that kind of a crop. And why would they be saying this and it not be true? Well, I think the easiest answer is they want to hold on to their export market because they're really using wheat and crude oil and a couple other major exporters, commodities, to really fund their war machine. And it wouldn't make a lot of it would make a lot of sense to me that they would be moving in that direction as far as trying to keep their market and keep their export base intact by saying, don't worry, we've got plenty.
Well, you mentioned corn can't seem to do much without the help of wheat. And I would say corn just can't catch a bullish break. And that's despite, I know we got new ethanol data out Wednesday. We got record ethanol output, yet that didn't move the corn market really at all. I want to talk about this for a second because corn just, it's stuck right now, it seems, Mike.
It made no sense whatsoever to take the July 12 cents discount to the December, given last week's ethanol and last week's export numbers, except that the trade was starting to say Brazil was going to have a huge demand production base, but it's going to be also met with maybe a little bit more domestic demand, and their net exports aren't going to be that much bigger than what we're used to. But this week, Jesse, I don't know what you can say. I mean, we did see the July corn come back to par with the December during the intraday trade on Wednesday, both around 440 at one point. That gave way to about a penny and a half, 2 cent discount in the July by the close. But this, as you say, record ethanol production of 1.12 million barrels a day. And even with that, we made a new 2025 low in ethanol stocks. This just can't, you just can't get around the idea that this demand side of the equation, both foreign and domestic demand for corn, is literally red hot given this time of the marketing year. So that really calls into question, and you brought it up a minute ago, it really calls into question the 24-25 ending stocks number, the average trade guess, 1.39 billion bushels for the old crop corn. I'm at 1.41, but I probably should be lower than the average trade guess, given these numbers that we saw today. But it may just really be a situation where we're going to have to wait until we see the grain stocks report to wake this market up again, that our demand is outpacing supply, simply put. So again, I think this kind of ethanol number and stocks number would suggest that WASDE report is elevated in terms of its importance to try and be the referee in all of this.
What about the soy side of the equation here? I know we saw a little bit of spread action late in the session Wednesday. Old crop sold off a little more than the new crop. Let's talk the November soy and look at the seasonal here and just your perspective on what we're seeing on the soy side of the equation, Mike.
Yeah, for me, Jesse, in the big picture, stuff we've talked about, I guess probably a month now, is I've really been eager to hedge with bought puts the soybeans, hedge with bought puts the cattle and feeders. Why is that? It's because I think their prices are premium and factoring in a very strong supply demand level at this point. More importantly, it's because of the policy. To me, soybeans have more to lose if the Chinese don't buy from us, and the cattle have more to lose, especially the feeders, if the U.S. opens the border up with Mexico and the screwworm issue goes away at the end of this month. My mindset is after this, I would call truce continuation between the U.S. and China in London when their talks ended. They continued with their low tariff mindset, but I would say also many in the trade, including me, were looking maybe for a little bit more in terms of long-term picture. So when we pull all that together and we see those new weekly lows in July beans, like you're talking about, in the lead month contract, which should be going down faster than the new crop, given South American production overbearing us on the supply side in the old crop versus very questionable situation on new crop beans here in the United States as far as conditions, plantings, drowned out spots. I'm hearing more and more about that east of the Mississippi River. Again, my mindset would be that July needs to break to the November, not go up to the November, and that we did the opposite based upon the U.S.-China trade excitement. And now that it's over, is it buy the rumor, sell the fact? Again, I think the trade report on Thursday may give us an indication. And when we look at this chart specifically, we see that we've broken away from the 2018 price action that I put the puts on because of, but I also put the puts on because of 2009, and we are starting to look more like 2009. In both those years, however, by the post-WASDE report time period, we were back in a downtrend, and we slid in both of those years all the way into the July 4th holiday. So my hedges are highly predicated and highly based upon and weighted upon the WASDE numbers on Thursday.
We're talking with Mike Zuzolo from Global Commodity Analytics here today on Market Talk. Mike, let's go over to the livestock complex. Here we are, cattle more lifetime highs, bit of a pullback though on Wednesday, feeders more so than live cattle futures. But when you take a look at this complex, let's talk about live cattle versus that boxed beef price, as we've been hitting on this for a few weeks now, that the boxed beef, maybe when we start to see a pullback there, that could be the indicator that we're starting to top out in this market. I mean, what are you watching this week when you look at this correlation?
Yeah, I think that's highly likely based upon history. And what I like about this chart now, Jesse, is what we've been tracking. I've got probably 5 or 6 factors right now that would indicate to me once those boxes are checked, we have a very high likelihood of a major high in the price of the cattle, led by a major price high in the feeders. This boxed beef price, choice box, is getting up to levels not seen and actually surpassing those levels seen back during the pandemic is a real shock. And to put it in a frame of reference, because everybody's so excited about the tight supplies, that I still think the USDA believes is not that tight because the on-feed numbers only being down about 2% from last year at this time. Look at the choice box beef compared to where we were in 2014 and 2015. I mean, we literally have doubled it now at least. So that's point number one in this chart. I think point number two would be, I believe what we have going on in the fat cattle right now with June in delivery as of this past Monday and going all the way to the 30th of June, they have a lot of open interest still in the June contract. And I think we've got a short squeeze going on in the June, and that's giving us the upside potential along with the box beef. And I admit the Texas price hitting close to 235, the Kansas price hitting close to 235 in the cash market, that's helping as well. But I also feel as though a big reason why we continue to go higher here is bigger open interest than normal in June cattle, and that there's some shorts in the market that are getting squeezed because of the delivery process and the trade thinking that there's a tightness in cattle out there. So as of Wednesday, when I finished up, I saw that we were looking at about 15,000 contracts of open interest still in the June contract. That compares to over 166,000 in the August. So we are whittling those numbers down. I would think by the end of this week, the June would be pretty much done running the show, unless the cash says otherwise. And so that's the first thing, the first what you would call disconnect that I'm looking for is, do we stay 235 in cash and keep the June running hot, or do we top out in the cash and the June signals that we're done for the upside at this point? And obviously the feeders play the big role there too. I've always felt like the feeders need to top before the fat cattle.
How about the feeder side here as we look at the positioning of the funds and that managed money here in feeders compared to the price action? As I mentioned, feeders were worse off on futures Wednesday. What are you tracking on this side of the cattle complex?
Yeah, this is another box that's been checked. And, for clients and subscribers, they know all the boxes. So if you want to sign up for a trial or become a subscriber and client, please, do so and would welcome the business. And I think I can help you in this time period because this is the second box that's been checked that would suggest that we are near a major high. We've now gone ahead in the yellow line. We've now gone ahead of our last record net long position by the managed money funds. And so they are extremely long feeders and now a record long feeders after this past week. I suspect that is probably still part of the net record long at this point, but this I think helps explain why the feeders have slowed down a little bit here this week. I would say we don't want to forget the long feeder short corn spread that this trade has been in essentially since mid 2024. And that's why they're so, in part, why they're so net short the corn market. It's not because of the corn fundamentals. Not the U.S. fundamentals, not the global fundamentals. It's because the feeder longs that they're in. So these funds, I think, are heavily weighted on the wrong side of the playground here in the teeter-totter by being so long feeders and so short corn, especially as we get into the second part of the calendar year.
Something else too, I'm just curious your thoughts on this. I've heard a little bit of chatter and rumor in the trade that maybe there was some nervousness with some of these packing plant immigration raids that are starting to show up in Nebraska and more. Just curious if that maybe got into the cattle market psyche at all here at midweek, Mike.
It has been talked about. I don't think it's gotten into it yet, Jesse, but I think you're right on point as usual. That would be another one of those feed the bull type scenarios that come in out of nowhere. And so with 50% of my Q3 hedges in place on bought puts, I stand back for a while and I let this situation develop. If we slow the chain speeds, that's going to mean a tighter supply in the near term, but it's going to mean heavier cattle and bigger supplies once we get those chain speeds back up and running. So I would look at it as near-term price friendly, let the market adjust and go higher, kind of like what happened with the border and the screwworm. I guess the question I would ask myself right now, and most ranchers I think would agree with me, at least the ones I've talked to would agree with me, would we be at these price levels had we not shut down the Mexican border? And I think that's really all you got to ask yourself as to whether you hedge. And people are using livestock revenue protection. That's fine. That's great. I prefer a combination because I want to be able to pull positions on and off because of the nature of this market. But I think that's what you really want to ask yourself before you make a determination on whether you need to hedge or not. And I'd see it the same way in beans. I mean, we have to ask ourselves, are we in a similar tariff situation as 2018? And I'd say, yeah, we really are. If China decides not to buy from us, the USDA numbers are too high on the exports. And I don't think it has to be more complex than that, quite honestly.
No, that's a great point. Mike, anything final you would add or reiterate as we close out the show today?
No, I continue to love the new highs in the crude oil, and I love that we're still down near the lows on the month with the U.S. dollar. And I love the fact that we're at an 8-month high in the Brazilian real. I mean, those are kind of things that underpin this market in the big picture, and I think keep the funds running into the commodities on breaks and should keep them still doing that. Even with the weaker CPI data, wasn't that much weaker. So I still think we got plenty of inflation to trade in these markets the next 6 to 8 months.
Mike, if folks want to learn more, reach out for a conversation, what's the best way?
globalcomresearch.com, and that's globalcom with 2 M's, research.com. Sign up for a 2-week free trial.
globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Thanks for joining us, sir. Happy Father's Day to you, and we'll talk to you again next week.
Happy Father's Day to you too, Jesse. Have a great one.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.